All right, you guys, this is being recorded. And of course, one thing I say at the beginning of every single webinar is watch this again, especially if you're new to options and or new to this option strategy. Watch it again because the nuances may go by you. You may be thinking of a question or something like that, or something that I have said, and you may miss out on something. Also, the other side of it is if you watch it again relatively soon, it makes it sink in further. It goes closer to the long-term memory, okay? I'm not necessarily saying you're never going to forget it if you watch it right again, but if you review material after you first learn it, you have a much better chance of remembering it later on, okay? Trust me on that. I started out in psychology. All right, so this is going to be the ratio call spread, all right? And this goes along with the advanced options I've been talking about. We're getting into advanced options now. And that being said, this is just a long call spread that we're adding a little risk to in order to get rid of some risk in a sense. We're going to have no risk to the downside in this, but we are increasing our risk a little bit to the upside. So, you know, some of these ideas behind this, when you're looking at a long call spread, you're thinking, God, I'm wildly bullish in this. But when you add that extra short call in there, it makes it a little bit more neutral. And we can even show that in the deltas a little bit later. But also one thing I'm thinking of right now, when I pull up the platform, remind me to show you guys how this can be IRA appropriate. All right. I may forget about that, but I'm thinking of it right now. So if somebody out there could remind me, I would appreciate that. All right. My name's Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or Wall Street Journal. I've been trading my own money for over 25 years now. Like I mentioned, I started actually trading in college with a psychology degree with some money I had earned. After realizing that's what I wanted to do, I switched it over to finance, graduated with a finance degree, and moved to Chicago and started trading on the floor after selling all my stocks and everything else. But in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. Well, pretty much all market conditions. Real quickly, any opinions, news, research, or analysis, or other information contained here is to be provided as general commentary and does not constitute investment advice. I wholeheartedly agree with this, you guys. The fact of the matter is I want to teach you guys how to trade. And some people ask, why you want to teach everybody how to trade and all these little secrets and everything else? Because we all have our own market assumption, all right? And if we have our own market assumption, then it really doesn't matter if you're taking all my little secrets and implementing it in the market. What we're doing is we're creating better markets. You know, that's free market price discovery. You can use my rules and it just tightens up the market for everybody and everybody's happy as far as I'm concerned. So that's my end goal, is to teach you guys to take control of your finances, but ultimately it creates a better market for everybody. All right. So bottom line though, do your own homework, and please remember the past performance of any trading system or methodology is not necessarily indicative of future results. Couldn't cut it. What's that? Couldn't cut it a shrink, huh? I don't know what that means. I don't know where we're going with that. All right. Also, you guys can follow me on Twitter at Wolfman's blog. I haven't been really active in Twitter. I watch it, but I don't tweet out a whole lot as of right now lately. But I will be tweeting out my earnings trades. And you can follow our parent company at ProTrader Strat, all right? All right, the ratio call spread. Ratio call spread is also called a 2-by-1 or a front ratio call spread. A 1-by-2 or then a back ratio spread is where you would be buying 2 calls and selling 1. So please don't confuse that with what we're doing here. I wouldn't generally implement a back ratio spread, but the front ratio spread, a 2-by-1 call spread, we will be able to try to do this for at least a credit, or actually for at least no outlay of money, but we are shooting for getting a credit in this, just a small credit, just so we can have no risk in one direction at all. All right. Because there's no sense in adding risk, you guys, to this strategy if you are still paying a debit and you have risk in both directions. Does that make sense? When you're buying a call spread, you have risk to the downside, right? You have that risk that you paid a debit for that you could lose if you're directionally wrong. By selling this extra call with this strategy, the idea is to mitigate all downside risk. So if you're adding risk, you need to have something in return, all right? And in that, we need to mitigate our risk to the downside. So if you have to do a ratio call spread and you're looking at it for a debit, move on to another strategy, all right? Oh, it's a shrink. I failed typing. Okay. I did take 1 year of psychology. I can give you my best Freudian stuff. All right. So that's why it makes it a little bit more neutral, because we don't want it to really rally super hard. All right. We don't want like a $20 move to the upside. That's going to hurt. We just want this thing to slowly trudge up, maybe come up and pin our prices. You can use Fibonacci and things of that nature, even market profile, to try and figure out where your short strike should be, where that resistance is going to be, or where the market wants to migrate to, with market profile. We talk about point of control being a magnet, and the daily market commentary is when I'm talking through my trades. That's the type of place where I'd love to have that location for the strikes that are short. All right, so the front ratio call spread, like I mentioned, we're buying an out of the money. If you go online, they're probably going to tell you to buy the at the money. But I like to go just slightly higher than the at the money, maybe the closest out of the money strike. And then you sell two further out of the money calls. It's basically, when you're setting this up, it's not a lot of decision making going on. You're pretty much going to be able to see this right away, whether or not it's going to work. The other thing is you're also going to have a pretty tight spread. If it's under $100, most likely it's going to be maybe $1 wide, maybe $2.50 wide, but it's usually pretty close to being the next strike is where you are selling. So it's a pretty tight spread, right? What date and time for the strikes? I'll get to that here. We're getting ready to fire that up right now. The rules are the essentials to success is picking the right environment. We need high volatility in this. And the reason why we want high volatility when we're doing this strategy, a long call spread, we want really low implied volatility. But when we add that extra short strike in it, it changes the dynamic, the whole paradigm, I guess. But the reason why we want high volatility is so that we can get further away from where the underlying is trading. And one thing here, I'll show it here actually. What we see on the standard deviations or a bell curve, you have your standard deviations, and it normally kind of looks like this. Mine's a little bit skewed, but you don't always see a perfect bell curve. So let's just say this is a normal bell curve. This is zero where the underlying's trading. This is one standard deviation away to the put side, negative one, positive one standard deviation to the call side. All right. Now, when we have high implied volatility, what it does is it really weighs down on this bell curve. And what it does is it kind of squishes it out. It makes it really long and maybe a little bit more exaggerated than that, or than normal. But then your one standard deviations end up being way out here. Okay. And my idea of, that's not a Q, that's a standard deviation. Sorry. It's not a very good one. But anyway, and even if the underlying didn't move, that's what would happen. This would still be a 16 delta. This would still be a 16 delta. 16 delta is one standard deviation, by the way. And we're further away from where the underlying is trading. And then when that volatility comes out, then you get that snap back to reality, or a normal bell curve. Maybe even it goes really low and then your one standard deviations are well inside that. okay? So we want high implied volatility because we're getting short some contracts and we want to get further away from where the underlying is so that we have a higher probability of success, right? Picking the right underlying. When I talk about picking the right underlying, this goes back to when we're looking at the option montage. Any stock under $100, let's look at a stock under $100. Any stock under $100, the bid ask in the spot month, and this is the, if you ever hear me say the option montage, this is the montage. All of these different things is the option montage, okay? What we want to do is take the spot month, which is the one that's going to be mostly traded. This is a full month. Expiration is tomorrow, so that's not really a spot month. Most people have rolled out of that July and into the August by this time, and this is becoming the spot month. So look at the spot month. Bid ask 10 cents wide on any stock under $100. It needs to be at least 10 cents wide. Anything wider than that, you guys, you have to give up too much edge to get in. And if you have to give up all that edge to get in, you have to give up a bunch of edge to get out. So in and out will eat up your yield if the bid and ask is really wide. You know, you could see a stock that's like 30 cents or 40 cents or $30 or $40 being 20 cents wide or something like that. Stay away from those. There's not enough people in there participating in order to get a good market. You might be stuck in that trade for a very long time just to get back to break even. Think about it. If it was 20 cents wide on the stock and it was decaying, nothing else changed, and it only decayed 2 cents a day. That's what theta is telling us, is that it's going to decay basically 2 cents a day for the same strike. If it was 20 cents wide, I got to be in this 10 days in order for a scratch. That's way too much risk, you guys. That means you have to really be right, directionally right, or you are so wrong, okay? So we want to have tight bid asks and don't want to have to give up too much edge on that, all right? And when I gave that example of the theta decay, that being said, that was on a short when you're selling it. You know, if you sold it and had to give up 20 cents, then you'd have to be in it for 10 days, right? If you had to buy it, pay up 20 cents, think about that. Now you need to make up about $1 move in just a few days in order to make this be worth the same in about 10 days, okay? It's in order to make up that 20 cents you gave up in edge. All right, so stick with tight bid ask. Anything under $100, 10 cents wide. Anything over $100, you know, we just moved the decimal place 3 ticks to the left, and that's how wide they should be. Google's saying it should be $1.18 wide. I have way too many strikes open, and you can see this is inside of that rule, okay? Does that make sense for everybody? You know, CMI sometimes gets a little wanky after the close, but my rule here is 3 ticks to the left, 10 cents wide. And I just checked this right before the close because I trade CMI a lot, and the markets are usually closer to 10 cents wide. They've gone to about 15 cents wide. But make sure they fit that rule. 23 ticks to the left after the close, it can get wider. This is during the open market session that rule applies, all right? 3 ticks to the left. This 3M should be 20 cents wide, okay? All right, so the next one was picking the right duration. We want a lot of theta decay, right? Because we're short 2 strikes. We're short the strikes trying to get a credit. We want that theta decay to happen on those short calls. The other thing is, one thing to note with this strategy, if you put this strategy on, right, and let's just say we do it for no credit, and it was just 0. And we were directionally wrong, so we're not worried about the downside here, all right? Because we don't have any risk to the downside. But one thing I will say is if you can look at those options, those short options, and they're only worth maybe a nickel or something like that, I have a tendency to cover those, or at least one of them. And, you know, then I have on that long call for maybe a nickel now because that's what I've totally paid out on this entire thing. If I did it for zero and I had to buy one short call back for a nickel, it really means I paid a nickel for this spread, right? I'm willing to lose that nickel in this situation because I've taken off the risk to the upside. So now if I get my market direction to the upside, you know, I have just on a long call spread for very cheap. So you can play around with it that way as well. All right. But we want this theta decay to happen. So when we're setting this up, we want to be somewhere inside of 45, 35 days to expiration. 35 days is really the sweet spot. I like actually even doing it outside, you know, right around 45 days, somewhere 45 to 35 days. Right now we're in this wheelhouse, 28 days, but we're still having a lot of theta decay happening. So I don't have a problem setting this up around the 28 days either, as long as it fits the rest of the rules. Okay. Sweet spot is 35. You know, you go out to 45, you can come into 28, but we still are going to get this nice steep theta decay happening in our options that are further out of the money as well. All right. And picking the right strikes. I've mentioned this a couple of times. We prefer to do this for a credit, but at least make it a scratch. Okay. It means you didn't pay out any money other than your commissions. Okay. You know, there's a couple of things in life and trading, and that's taxes and commissions, right? So picking the right strikes. Make sure when you're building this strategy, if you've increased your risk by doing the ratio, you need to get rid of some of the directionality, and that is to the downside with this particular strategy, okay? And then knowing our exit strategy, I'm looking at getting about 50% of max profit on this. So whatever the width of the spread is, we're taking half of that, all right? If it's a $5 wide spread, we do it for no credit, then we're trying to get out for about $2.50, okay? And if we're directionally wrong and it goes down, just look to cover, you know, managing some of this, staying mechanical, take off one of those short calls. That short call that you're taking off was the thing that actually financed the strategy. So once you take that off, you've gotten the strategy for almost free. So I have no problem with that. But make sure you're getting out for about 50% of max profit if you have that opportunity. All right. Max profit is our short strike minus our long strike. Okay. Remember our long strike is that one that is closest to the money. I write this up from the higher strike just so we don't get a negative number and nobody's really confused. But our one short strike minus our long strike, which is just the width of the spreads plus the credit. If you do it for zero, then you don't add anything in, obviously. But it's just the width of the spreads, right? All right. But our max loss is infinite. We've increased our risk. That short call is the risk. The one short call is our risk for the infinite to the upside. And remember, we can only make our max profit is the width of the strikes because that's our long call spread. Our max loss comes into play from that short extra call. All right. And then our break even is the short call plus the max profit. All right. Because remember that short call and that, the short call plus the max profit, because the width of the spread is going to give us that room to the upside. All right. So if it was $1 wide and our short calls were at the 50 calls, then our max profit would be, our max profit would be $1. So therefore our break even to the upside, we get that, we still get to keep that $1 for the long call spread, right? The long call spread still generates money up to that 50 call that's short. And then we start losing money on that second short call for that distance of in the width of the spread. Does that make sense, or did I lose anybody there? All right. So the call spread finances us a little bit to the upside. So if it was $1 wide, then, the max profit is that width of the spread. You add that onto the short strike. So you get wiggle room to the upside. Sorry, break even. All right, so let's pull up the platform is what I meant to do. The platform here. So this is where I usually throw it out to you guys. Give me some examples, you know, throw out some stocks that you guys like to trade, and I'll throw it on here and we'll just walk through it as an example. With 3M, you can see somebody just has resting orders in here at $2. I'll sell anything at $2. All right, Amazon. Let's look at Amazon. It's the first one I've seen. So AMZN. And one thing is, I don't do this around earnings. We don't have a choice right now. We are just at the very beginning of earnings season, and this earnings season is going to go on for another month or two. So usually set this up when there is no binary event. A very clean month is what we would like to have in that 45 days, like nothing landing in there. Like for drug stocks, you wouldn't want a trial result. And for, bonds, you wouldn't want an FOMC meeting. And for stocks, you don't want that. We don't want the earnings in there. It's going to be very difficult to find something. And one other thing to note, it's really hard to do this strategy with really cheap stocks below like 20 even or $20 or so. So, the larger price stocks make it a little bit easier and a little bit wider. If you're doing the USO or something like that, it might be a 50-cent wide spread. And for me, that's not worth the risk, right? On something like that. So I'm going to walk away from the smaller ones and use this in and around something over $50 most likely, and end up. So that's where I'm looking for this. So Amazon does have earnings, but let's just look at it because we know it has high implied volatility. One of my rules is high implied volatility. We need high vol in this in order to set this up to get our strikes really far out. Remember that bell curve. We want to get as far out as we can on that short strike. You can do this with low implied volatility. You could go at a very low implied volatility. This will work out according to some of my rules, where you'll be able to do it for no credit or a small credit, things of that nature. You can set this up where it meets all the other rules other than this high implied volatility one. But keep in mind, we're trying to set one of the few things we can do to be successful in trading is setting up our strategy correctly in the beginning. Okay. Taking those extra couple of steps, following these rules, making sure we're checking off the boxes in order to implement this strategy. If you don't have high implied volatility, you're going to be selling these strikes very close to at the money. Because like I said, even a 16 delta is a 16 delta because it's the probability of being in the money at expiration, right? That's what delta tells us. A 16 delta is the probability of being in the money by 1 penny at expiration, or a 16% probability. Now, one thing I want you to think about here is when you have a 16 delta and low implied volatility, it might very well be this close. I'm just giving you ballpark estimates here, but a 16 delta and really high implied volatility might be way out here, but a 16 delta with really low implied volatility would be right here, right? Because volatility increases the range a little bit. And the idea is when volatility is high, it comes in. When volatility is really high, it comes off, even here where it was really high. And that would have been a clean month. You get that volatility coming out, that's great. That's exactly what we want. It will allow us to get out of this strategy earlier, all right? So something like this, it was a clean month, had high implied volatility, something like that. Volatility is going to come out of it when there's nothing to talk about. Mary, yes, you can use this for ETFs. Absolutely. All right, so back to Amazon. So that fits the rule. Amazon, 3 ticks to the left, $1.80. That fits the rule here, $1.80. It's inside of that, right? So we're meeting our rules on there. So what I would want to do here is try and buy something relatively close slightly out. It's trading 118.12, and I'm going to be looking at probably the 118.30s. You can even go in here and look at your charts, say the 118.50 printed yesterday, and might want to roll over. This is a pretty good idea for this strategy, especially if you're really bullish in Amazon. You get these small corrections and you think maybe it's going to bounce off this 61 fib, come down, bounce, and then continue higher, then this was a perfect situation for that, right? Because we're going to get that theta decay as it makes that little bit of correction and then start moving higher later on. That's kind of what we want for there. And I did answer, yes, we can do this for ETFs, right? I want to make sure I got that out. All right, so we're going to kind of come out just a little bit. I'm going to go to the 30s. We're going to buy one of those. And then we have to try and figure out $59. So I want to sell something for somewhere right around 30 to get that, right? $60 I need to sell in order to get to there. So it's probably going to be this strike right there. Boom, boom. All right. And we get a $5 credit. Now, one thing to note with this, let me try and see if that's going to, no, it's not going to let me do it. All right. I'll just have to build it out this way. Let me get down there, I probably should just punch it in. All right. So a 1 by 2, we're long 1, short 2. Now, what are this? We got a $5 credit. That's great. Also, remember, we have a $70 wide spread here. So that $70 gets us up to what? Where's our break even? Here, I'll show you guys on the Analyze tab. It might be a little bit easier. It's from an old strategy. Oh, let me do that again. From an old webinar, I guess. I never deleted in there. So let's analyze this trade. So again, it kind of looks similar to that broken wing butterfly that we did, although we have continued risk now, okay, to the upside. You can see to the downside, we have no risk. We have completely continued risk to the upside. And our break even is going to be this $70 wide, right? That's our $70 wide strike. And that brings us out to the 1970. It's 1975, right? Got the $5 wide, $70 spread, because once we start rallying up to 1900, that gives us $70 profit. We nailed it. Now, above $19, you can see, or above 1900, you can see we start losing some of that profit all the way till we get to 1975. And that's because we got the $70 spread plus the $5 credit. All right. So we've got a lot of wiggle room to the upside before we're wrong. Now with Amazon, like I said, you start seeing it go down. Well, you really don't care all the way down, right? You made $5 on this strategy to the downside. So I don't care about that, especially in the beginning. I'd like it to go down, the market to trail off a little bit, volatility come out of this, and that will allow us to get to our profitability faster. And one thing we can show with volatility, this is the volatility adjustment, not volume. Had a Twitter thing go on the other day, and the guy was talking about vol, and the guy was like, what does volume have to do with it? But you can see as volatility comes out, I'm making this more negative. This purple line starts increasing, which just really gives you an idea as to how the profitability starts happening quicker. And it's really only going to happen quicker to our credit. That's what's really decaying. The market hasn't moved at all. I haven't adjusted anything else, but that's what we want. This purple line to start rising up, and you will see that when volatility comes out, because that extra short 1900 call I sold is the one that's decaying with that volatility coming out. All right? Is everybody still with me? All right. Good. All right. The next one I saw, so that one would work out if we didn't have earnings. I would not ride this through earnings. All right. And then the next one was Target. So let's look at Target as a trade. Delete that. All right. It's got low implied volatility percent. Now, when I was talking about high implied volatility, you guys, it's not just high implied volatility being 25 or where is my Twitter? Twitter is up in the 60s. All right. So Twitter has a 60 implied volatility, and that's not this number here. 60 implied volatility. So Twitter has high implied volatility compared to, say, like Disney or probably Kroger and any of those other ones, right? But what we need to know is what does 60 tell us? Yeah, it's volatile, but we get that. What we need to know is it volatile for Twitter? And what you do is you take this math equation or this fraction, and in the numerator, we take the sum of where the market currently, or where the implied volatility is right now, 62, minus the low of 30. So 62 minus 30 is 30. And my eyes are bad. I can barely see over there. So I might be off by a couple of digits. And then 77 minus 30. So we've got 33 divided by 47. So that puts us up at around 70%, right? Okay. So that's what I mean by high implied volatility. It's high implied volatility percent. So it has high implied volatility for itself. So if you guys ever hear me say, God, this stock has high implied volatility, what I really mean is high implied volatility percent. It has high implied volatility for itself. Do you sell Delta 16 strike? No, but what I want you to know about this is what we talked about with that Amazon trade. Let's go back to Amazon. With that Amazon trade. So we sold that, without building it out again, we sold that 1900 call right here, right? Where's 1900? Blind guy. The blind guy. So if we add back in that break to our break even, right? That's $75. Let's go $75 higher and see what it looks like. $75 higher, it's right going to land between here. So it gets us almost to that one standard deviation. A lot of times it will get you outside that one standard deviation move or right to it. So that's the idea of this strategy is, yes, it's a little bit tight. Yes, we did add risk, but think about it. We have an 84% probability of success with this strategy, right? Because my break even is all the way up to almost the 16 delta. If it were the 16 delta, let's say it's the 19 delta. Now I have an 80% probability of success with this strategy. So it seems like we've got a lot of risk going on, right? We got a really wide spread, and I'm in Google or I'm in Amazon for this example. But think about it. You got a massive credit. You got that $70 credit and a $75 credit. So when you always take this into account, because you're going to be looking at these strategies and going, God, man, I'm really close to the market and the spread. But that extra distance to the upside gives you almost to the one standard deviation move a lot of times for your break even. And really, that's where our profit and loss lies, right? Is where our break even is. That's where we're successful or not successful. If we're below our break even, we're successful as far as I'm concerned. All right. So it gives you a lot of room to the upside, all the way up to 1975. And on the charts, we can even go back to your charts like this, 1975 is going to be, almost up here. There's no line, but you could also, because it's Amazon, there's no line there. So there's risk all the way to the 100 if it goes through the 78. But if it just even comes up to here, we're going to be looking pretty darn good. I would love it to just go up and nail the 78 Fibonacci and stick there, right? So for me, this is a pretty good strategy, pretty good setup. I may even implement this tomorrow on this one because I think, it looks like Amazon might, actually, you know what? They have earnings, so I probably won't. So it looks like it's going to roll over. But if I had this kind of setup in a clean month, that to me looks like there's going to be a little bit of a correction before a resumption of a rally. And that would be a good time to kind of set this up, because I really don't care if Amazon falls out of bed. And when I mean by fall out of bed, that means tank, because I'd get to keep that $5. All right. So another one, did I look at Target yet? So Target, it's up against a major resistance area, so I wouldn't care about it going down necessarily. I can look at a couple of other things. Looks like it's really trending sideways here. That could be your market neutral assumption. Maybe you think it's going to build out at this price. We've got a couple of nice resistances above here, so 80, 82-ish. All right, so let's just look at our option montage. Do we have high implied volatility? No. So that's what we did look at that. It has low implied volatility. What was the other one? Tesla. Actually, you know what? Here, I'll look at Target real quick just to show you an example of, we could do this like right here, go to the 82.5 and then sell 2 of those. Well, maybe not. Thought you'd be able to do it. You got to do it for credit, so it wouldn't work. A lot of times it will work on low implied volatility. I was hoping we would get an example of that, but don't do it in low implied volatility because you're too close. All right, Tesla. I would love to be wrong on this strategy. Okay, so Tesla's building up. I mean, it's not really gone a whole lot. You got a couple resistances, support here. It found very strong, so you don't have to worry too much about the downside. If it rallied, it could go right to the point of control and pin there, right? So with me, I would probably try and pick the short strike somewhere around the 340 maybe, or at least have that in mind, because I think that markets migrate to the point of control and then settle down there, because that's where the most time and volume's been spent. Think about it. If you're long a stock and it's right where you bought it, you really have no anxiety. You don't feel like you need to buy more. You don't feel like you need to get out of it, right? Everybody's that way. Same thing when they're short. They don't need to add any. They don't need to get out of it, right? So that's what people are thinking when it's right around the point of control, because that's where the most amount of buys and sells have happened, the exchange of money. That's where value has been set by the broader market. Whenever there's the most amount of money exchanged, that's where that market has found, free market price discovery has found value. All right. So that's what we're looking for. So in this one, I would look to buy just slightly out of the money. What is it? 25. So I'm $5 higher. That's out of the money. The 20s are the at the money as far as I'm concerned. So $17 I've got to come up with and come up with as a credit. So that to me is looking like the 350s, because this is going to only give me about $14. This actually 17. It's going to be slightly shy. I'm going to have to go to the 45. So I'd sell 2 of those, and now we got $2 credit on a $20 wide. That gets me up to $67.15, right? Because the width of the spread, $20 plus the credit is $2. So $22 to the upside gives me 67. All right. So that 67 correlates very closely almost to that 1 standard deviation, right? It's always going to come up just slightly shy, but it is close enough that it makes it basically an 80% probability of success. And if I told you, we could do something 100 times and I'll give you $1 for every trade, but your 80% probability of success, wouldn't you do that 100 times? Yeah, sure. The first 20 times you did it, I was taking dollars from you, right? But you know the probabilities. The next 80 times are in your favor. All right? Because the probabilities are the probabilities, you guys. They will work out in the long run. So if you do this strategy and the first time it bites you in the nose, then you know the probabilities beat you on this one. The next couple of times, your probabilities are in your favor, all right? Earnings season hasn't kicked off very good for me, which was the same thing as last earnings season. First 3 trades I think I made last earnings season were losers. But I said last year in the daily market, or last earnings season in the daily market commentaries, I was like, I'm kind of glad. Now it's out of the way. I've lost money on these trades. Now the probability is going forward in my favor. And as you guys know, I turned it around because I just kept playing the probabilities. They will work themselves out. So the idea ultimately with this strategy is to get as close to that one standard deviation move, that 84% probability of success. It's normally going to be about an 80%. So a high probability strategy, whereas if we just did the long call spread, that's a relatively low probability strategy because you have to get up to that short strike in order to make the full width. And to get up there is a relatively low probability, right? And one thing with probabilities on delta, somebody is asking, delta tells us the probability of our strike being in the money at expiration in 29 days by 1 penny. Okay, our strike being, delta tells us the probability of our strike being in the money by 1 penny at expiration. So 21% probability or whatever. Now my short strike is a 45 delta. Now this is why I like it, because you're going to be able to get to your 50% of max profit rather quickly, because our short strike only has about a 34% probability of success, right, of being in there. So we don't have a huge probability of it pinning on that number or coming up there and staying there at expiration. But delta, a floor trader hack was delta times 2 gives us the probability of being tested, of testing our intestinal fortitude, whether or not we can stay in this trade. Okay, so there's a 60, almost 70% probability, 2 times 34, 70% probability that Amazon in the next 29 days will come up and test, Tesla will come up and test that 345 strike. Okay, but only a 34% probability of finishing 1 penny in the money at expiration. So that works out, aside from the earnings, that if we could get that in a high probability or in a high volatility market. So another one is gold, but I'm going to look at, somebody's doing /GC, but I'm going to do GLD because Mary also asked about ETFs, and GLD is an ETF. So it's the equivalent of gold, right? But it's an ETF. Now with ETFs, high implied volatility is anything above 30 for me. So stocks, anything above 50 is high implied volatility percent. I should put that in there and make sure I don't confuse anybody. ETFs, anything above 30 IV percent is acceptable because it's a basket of goods, right? Something might have really high implied volatility and something has really low implied volatility at that time, and they kind of meld each other out. Okay, so it kind of still levels each other out. Did you sell deltas? Okay, so Banu, I answered you, right? We got that, right? The credit gets us almost to that 1 standard deviation strike, which is what I was talking about with that one, where we're trying to get to that 1 standard deviation. Maybe I wasn't very clear, or may have misspoke, I guess, because I don't remember exactly what I said. And I do have a tendency, because think about this. I'm like flying an airplane in here. I've got like 100 different things going on, and I'm trying to keep my wits about me. So I do confuse myself sometimes while I'm talking, because I'm trying to think of the next thing to say and all that stuff. So what I meant to say, if I didn't say it clearly, was we're trying to get to that 1 standard deviation move, because that's a very low probability of getting to there. All right. Did that clear it up for everybody else? Because I'm sure somebody else, I may have confused somebody else as well. All right, so GLD, let's just look at a gold chart, because the ETFs only trade during the day session. Gold has overnight trading. Now, if you watch the daily market commentaries, I've been waiting for this. This was the Putin buy, and I can't remember exactly how many tons of gold they were buying, but I think it was
it was somewhere close to like 1,000 tons of gold, right? And he literally just drove the market up. This is right about when he stopped buying it. And when he stopped buying it, we've had this massive sell-off, okay? So to me, he was holding it up. A lot of these people are short. It's up against this 38 Fibonacci. And if you guys trade Fibonacci, you know that is a major buy zone for people. They like to short it when it gets up high and then goes, one place to cover would be right around the 50, which it looks like, the weak hands will get out at the 61. Most people will get out at the 50. And, if you can make it to the 38 and hold off there, usually that's where it starts really picking up. So I would say that this, we missed the sell-off, but we can catch the bounce. Now, yesterday I was saying, if we can get a confirmation today, then I was going to be all in on this thing for the upside. We didn't get that, so I stayed away from it. But the way the market acted at the end of the day, it's still looking pretty darn good for finding support here, okay? So therefore, for me, I'd like to play this to the upside as well, tomorrow, especially if it gets confirmation to the upside. I don't think it's going to go a whole long way, but it could easily come back up, maybe even test the 38, but I think it's definitely coming back for the 50. So let's look at that. We don't have a lot of days. This is inside of where I was talking about, the 35 days to expiration, but I also don't want to do this 65 days out and have all that risk. So I'm going to go a little bit tighter and look at my chart, just say, hey, I think it'll come up maybe to the 20s, but definitely to the 17. So maybe I'll play around with that. So maybe to the 17s, I could do this and go buy that and then sell 2 of those. It's a debit. I wouldn't do it for a debit. I'd put it up, try and get a credit or at least nothing and put that in there. Buy that one, sell that one. Oops, sell that one twice. Did I sell it twice? Try and figure it out. 19, sell it twice. Still does it for a debit. But try and do it. I thought I had this. So let's try this 16. Let's try the 16, 18 then. Still a debit. Somehow I got a credit on that earlier when I vetted it. The 16, 18 was a credit earlier, very small credit. I think it was a penny. So this is when I vetted earlier today, right before the close. And I was thinking buy the 16, sell 2 of the 18s, and basically get it for no outlay of money. $2 wide, that gets me all the way to 120, right? Because I get the width of the spread for my break even. That $2 adds into our short strike because I get that first call spread, finances, $2 of loss to the upside. So at 120 would be my loss area. So as long as it stayed below the 38 Fibonacci, came up and bounced off of there, I'm fine. So I've got a lot of room to the upside in order to be right. And then if I did this with no credit or with no outlay of money, I would not do this for a debit, then I would see profit on the downside, or at least no risk to the downside. Since the calls and the puts expiring at the same time, is it better to sell the short calls and make the IRA appropriate, then go long date with the long call? I wouldn't go long dated with that long call necessarily, because you're probably going to have to go really far away from the market in order to find that risk. And to be quite honest, it should be IRA appropriate for sure, because it's defined risk and your long call is further out. I'm just thinking through the strategy as we go here, just to make sure I answer it correctly. But yes, you could do that. But thank you for bringing that up. You could do that. I don't normally. But what I do with this for my IRA, and I would want to do it only if I was able to get a credit enough to where you do this strategy still for no outlay of money, okay? Don't pay a debit, because if you pay a debit by buying this call to make it IRA appropriate, then you've increased your risk in both directions. All right. You've increased your risk by buying that contract to the downside, and you still increased your risk to the upside because you're short that extra call. The long call is going to be so far away the way I do it, it's not going to limit your risk, because I would be out way before it got defined. So for instance, with this one, I don't even look at anything other than if I did this for a nickel credit or any credit, I'm looking for this first strike I can buy for a nickel, which would probably be this one right here, the 129 calls, and then I just throw that in there. I don't know why that went to because I have it locked. But, if I was looking at the original strategy for a 5-cent credit when I bought that one for a nickel, that defines the risks, or defines the strategy to make it appropriate for an IRA. Does anybody else know what we just did there? We created a broken wing butterfly. You guys that were watching last week's webinar, it's not the broken wing butterfly according to my rules, but it is considered a butterfly and a broken wing butterfly. It's not the skip strike like we would have talked about doing the 16, 18, and then going to the 22 for the broken wing butterfly. This is all the way out at the 29. All right. Do not take this strategy that far into you, okay? And as a matter of fact, if you have a lower risk tolerance, I would cover this probably before my break even got tested. If you have a low risk tolerance or you're newer to options, maybe get out when your break even's tested, or probably a little bit higher than that. But that's probably for you guys with this strategy. Look at when my break even is tested. That's where I'm really itchy on the trigger finger, okay? Where you're ready to fire it off. If it's looking pretty bullish on the charts, I just pull the ripcord on it and get out. So that's how you make that IRA appropriate. But do not take that risk all the way to there and hold solace in thinking that, oh, it's defined risk, I don't have to worry about it. That is going to be extremely painful. Don't do it. Cut your losses. Pull the ripcord. Get out. Quit messing about. All right? Anybody have any other questions? All right, like I mentioned, this strategy is going to be really hard to set up in the next month at least. But when we have high implied volatility like we saw at the beginning of this year, that strategy was great. I mean, it was knocking it out of the park. So when we're in those lulls in between earnings and we get that high implied volatility, look for these types of strategies to implement. But right now we're in earnings, so let's take advantage of it, you guys. This is the earnings with options, all right? I have all my favorite strategies, the rules, kind of like what I went over with this one, for earnings specific, the days to get in, when do we get in, when do we get out? I mean, I even talk about time of day for these type of things, all right? Very important to take advantage of if you like to trade options. These things are, earnings trades are my favorite, to be quite honest. You're in and you're out. You either made money or lost money, and you know it right away. Rather than just watching a trade kind of decay, Yeah, it's fun to make money like that, but it's also more fun to get in and get out of these and keep cycling, keep active, right? I love doing them quick and fast because the probabilities, I can keep playing the probabilities and they keep working, all right? So if you guys think you'd be better off trading with higher probabilities of success, you guys should really take advantage of this, especially for earnings. This is great. And if you enjoyed my instructions or my instruction at all, especially if you guys are one of my regulars and you guys are watching these daily market commentaries, take advantage of earnings. It's not, I mean, as scary as it is, it's not that scary, you guys. All right. And the best way to become a better trader is to constantly learn, which you guys have clearly done by taking advantage of this webinar. But
And I know you guys can go online and find out how to build this strategy, right? I know you can do that. They're going to tell you buy one, sell two, you're done. They aren't going to tell you the strike locations. They're not going to show you those standard deviations and things like that that I showed you. All of that stuff should make you more confident when you're building these things out and when you're trading, because you know the probabilities. So the best way to become a better trader is to constantly learn. Like I said, you guys have done that and I appreciate that. But trading with technical analysis and just trading with your options education by Google isn't going to be enough to create consistent winners. And I teach just that, how to play the probabilities, create consistent winners. And when the probabilities have gone against us, how to stay mechanical, right? To increase our probabilities even further in our favor. And that's what I talked about with this one, right? Think about it. We did this ratio call spread. I said, if you're directionally wrong, get rid of one of those calls. That's staying mechanical. That's staying in this game. All right. So if you can cover that call for a nickel because you're wrong, that's staying mechanical and keeping you in the game. If it comes back, then you guys are going to be really happy with me. And, if it doesn't, you aren't any worse for wear. All right. So when you guys are using the right tools in the right situation, you're going to be more productive, state of mind, be able to put on more strategies. And that's going to create more opportunities. If you have more opportunities, you're going to have you're going to have those probabilities roll back into your favor. And ultimately, all of that will build your confidence where you won't have to worry about it. You're going to be able to sleep at night. And that's what I want you guys to be able to do. I always say I'm a recovering futures trader. I started out trading stocks and then selling options against it. And then, the path of least resistance on the floor kind of led me back into futures. And I wanted to learn futures. So I started trading futures for quite a while. I was a real spreader, so I limited my risk that way. But and now I've gotten back into trading options. And believe me, you sleep a lot better at night when you're trading with options and you know your risk and everything else. All right. So take advantage of it. Oh, shoot. Sorry, guys. Somebody's asking. Let me get it in there. I forgot to put it in the chat window. It should be in the chat window right now. So that link for earnings is in that chat window. Take advantage of it for $36, you guys. I mean, you cannot beat it to get about 6 strategies or 8 hours of content for $36. All right. That basically tries to keep the lights on and makes it so we can provide this for you almost for free in a sense, because, we have costs of doing business too. So you guys are getting a great deal there. All right. Paste the link in the chat. Caesar, yes, I actually saw you pop that up and you reminded me. Thank you very much. So it is in the window there. Guys, take advantage of it. Seriously, earnings trades are quick and fast, and you have a lot of opportunity to make some money. You don't always have that many opportunities when it's outside of earnings season, as we do now. I've been talking daily market commentaries about 3 or 4 stocks a day where we can put on a strategy, 3 strategies a day, 2 to 3 strategies a day, get out of them the next day, put them on again, and boom, 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 boom. So you can see how quickly we can get those probabilities going, and then the probabilities will work themselves out, you guys. All right. So that's about it. I just one other thing, want to thank you guys all for participating in this webinar. Also, later webinars will be drilling down on different options, components, when and where I find trades appropriate. Here's also that link. You will have to pause it, punch this into your URL if you are watching this on tape delay and signed up for it, couldn't make it or something like that. Like one of our guys from Kathmandu or something like that. I can't remember where he was from. Thanks for watching. Also, if I didn't get to one of your questions, because you guys, when people are talking, it scrolls fast and I may have missed 1 or 2 of your questions. Reach out to us, 310-598-6677, or email me at trading@protraderstrategies.com. I'll get back to you on those questions if I missed you. I want to make sure you guys are clear of concept. So please take advantage of that earnings thing. And if I missed your question, reach out to me. All right. That's all I got for you guys today. If you can't take that, take it easy.
Take it easy, JQ.
Bye, guys.